Have you ever heard someone say, I'm investing in stocks or bonds are safer than shares, and wonder what on earth they were talking about? Don't worry, you are not alone. In this video, we will break down stocks, bonds, and shares in a simple way using easy examples you can relate to, even if you have never studied finance. By the end of this video, you will finally understand what they are, how they work, and why they matter. Let's begin with stocks and shares. Imagine you start a small bakery. Business is good and you want to expand. You need a bigger oven, maybe a new location. But here's the catch, you need money. So you decide to sell part of your bakery to other people. You divide the business into 100 pieces and you sell 50 of them to the public. Each piece is called a share, and anyone who buys it is now a shareholder. They own part of your bakery. These buyers are not giving you a loan, they are buying ownership in your company. If your business does well, their share value increases. If things go badly, they may lose money. Now, what is the difference between a stock and a share? Here's a simple trick. The word stock is a general term, like a whole basket of investment in one or more companies. A share refers to a specific piece of one company. For example, you could say, I own stock in Dangote Smith or I own 10 shares of MTN. Both are correct, just a difference in how specific you want to be. Shares are usually bought and sold on the stock exchange, like the Nigeria Stock Exchange, the New York Stock Exchange, or the London Stock Exchange. Yeah, investors buy shares hoping to make a profit, either through capital gains when share prices rises or dividends when companies pay out profits to shareholders. What are bonds? Now let's talk about bonds. While stocks are about ownership, bonds are about lending. Think of bonds like an IOU. When the government or a company needs money or does not want to sell ownership, they issue bonds. Here is an example. Let's say the government wants to build a new highway but does not have enough cash. Instead of raising taxes, they issue bonds. When you buy a bond, you are essentially lending money to the government. In return, they promise to pay you interest, say 10% every year, and then repay the original amount after a set period. That's the beauty of bonds. They are predictable income. Let's break it down. You invest 100,000 naira in a 5-year bond with 10% interest. Every year, you receive 10,000 naira as interest. After 5 years, you get your original 10,000 naira back. Simple, right? Stockholders are owners and may get dividends and price appreciation, but they face more risk. Bond holders are lenders. They get interest, but their returns are generally lower and safer. Bonds are often seen as less risky, especially government bonds, but they are not risk free. If a company goes bankrupt, bond holders may not get fully paid. Let's compare stocks and bonds side by side. Stocks or shares. Stock or shares give higher returns, but they are more risky, while bonds give lower returns but are more stable and predictable. So, which one is better? It depends on your goals. If you want long term growth and don't mind taking risk, stocks might be for you. If you want steady income and safety, bonds might suit you better. Let's look at real life examples. Uche is 25 and just gets her first job. She wants to build wealth over the long term, so she invests in stocks of Nigeria companies like GT Bank and Nestle Nigeria. Mr. Ade, a retired teacher, wants steady income. He invests in federal government bonds and they pay him interest every year. Both Uche and Mr. Ade are investors, but their strategies are different, and that is okay. The best portfolios often have a mix of both stocks and bonds, combine growth with stability. So here you have it: stock, shares, and bonds. Explain simply. Stock and shares mean you own part of a company. Bonds mean you are lending money to that company or to the government. Now that you understand the difference, you are one step closer to become a smarter investor. If you found this video helpful, please give it a thumbs up, share it with a friend, and don't forget to subscribe for more tips.